The four most dangerous words in investing are, "This time it's different." Sir John Templeton. Bitcoin right now? It's acting like a casino that just turned the lights on at 3 a.m. Everyone's still inside, but nobody's sure if the party's over or just getting started again. We had the halving, we had the ETF approval, we had the narrative, and yet price is rolling over. So what the hell is going on? Let me tell you a story. In 2017, Bitcoin ran from $1,000 to nearly $20,000. Then it collapsed 84%. In 2021, it ran from $3,800 to $69,000. Then it collapsed 77%. Different headlines, different villains, same cycle. Bitcoin moves in brutal, beautiful 4-year cycles. And if you zoom in, you'll notice something even more interesting. Within that 4-year structure, Bitcoin often respects 60-day cycles, short-term trend shifts, 30-week cycles, intermediate trend resets. Right now, we just rolled over from a 30-week high. This is not doom calling, that's rhythm. History doesn't repeat, but it rhymes aggressively. Now let's talk about the villain, liquidity. From 2020 to 2022, the Federal Reserve expanded its balance sheet from $4 trillion to nearly $9 trillion. That's real financial adrenaline. Bitcoin loved it. But today, global M2 money supply growth has slowed dramatically. The Fed's balance sheet is down roughly $1.5 trillion from peak. Real rates are positive. The 10-year Treasury is hovering around 4 to 5%. That creates liquidity competition. When you can earn 5% risk-free, speculative capital gets picky. Now, layer this on top. Spot Bitcoin ETFs pulled in over $10 billion in early inflows. Massive. But ETF inflows have slowed. Some weeks are now net negative. And here's the part nobody wants to say out loud. On-chain activity is not exploding. Transaction growth is flat. Speculative leverage, however, is not. Open interest remains elevated. Funding rates periodically spike. That's late cycle behavior, not early bull market behavior. And don't even get me started on meme coins. If your investment thesis involves a cartoon frog with a $2 billion market cap and zero utility or fundamental value, you're not early, you're exit liquidity. I don't hate innovation, I hate stupidity dressed as innovation. So what does this mean right now? It means Bitcoin is stuck between two forces. On one side, structural adoption. Institutions are here. ETFs are real. Sovereign discussions are happening. This is not 2013 anymore. On the other hand, macro tightening, stronger dollar cycles, risk assets facing gravity. And here's where it gets interesting. Bitcoin's correlation with the Nasdaq has been hovering between 0.5 and 0.7 in recent years. It trades like a high beta tech stock. And what are mega-cap tech valuations sitting at? The S&P 500 is trading around 20 to 22x forward earnings. The Magnificent Seven account for roughly 30% of the index weight. Concentration risk is high. If equities wobble, Bitcoin doesn't become gold, it becomes beta. So in the short term, if liquidity contracts and equities correct, Bitcoin likely doesn't escape. Now, technically speaking, if the 30-week cycle continues downward, we could easily see a 20 to 30% retracement inside a broader structure. That's normal, painful, but normal. And if the full 4-year cycle topped early, historically that means 50% downside from peak is not impossible. Not guaranteed, possible. That's the difference between analysis and fear-mongering. So, what the hell is going on with Bitcoin? Nothing abnormal. It's behaving like it always does when liquidity tightens and cycles mature. Markets don't die from headlines, they die from exhaustion. Right now, Bitcoin looks less like a fresh revolution and more like a market catching its breath after a sprint. Could this be a mid-cycle reset before another leg up? Unlikely, but yes. Could the full 4-year cycle have peaked and we're entering the cold season? That's my base case. So here's the move. Respect the cycle, respect liquidity, size your positions like you could be wrong. Because in markets, just like in life, survival isn't about being right,
It's about staying solvent long enough to be right later. And if you're betting your future on meme coins during a liquidity contraction, Templeton already warned you. This time is never different. It just feels that way, because cycles set the rhythm, not your narrative. And that's exactly why I made this channel, because the goal here isn't to chase hype, it's to understand the forces actually moving the crypto market. The cycles, the liquidity, the macro trends most people ignore, the things traditional financial media rarely talks about. So if you're interested in understanding what's really happening in crypto and global markets, consider subscribing. And let me know your thoughts in the comments, because the most interesting conversations usually happen down there. And the truth is, the biggest risks in markets usually aren't the loud ones. They're the ones quietly building in the background.